Listeners, welcome to this week's Victory Show. If this is the first time you're joining us, I'm Travis Cody, best-selling author of 16 books, and I've had the privilege of helping hundreds of business consultants, founders, and entrepreneurs write and publish their own best-selling book as well. During that journey, I've discovered a really fascinating pattern. A lot of businesses hit a revenue plateau, usually around about $1 million a year, and they struggle to break through it. So on this show, I sit down with some of the world's most successful CEOs, leaders, and business owners to uncover the strategies that they use to overcome those revenue plateaus and scale their business to new heights. And more importantly, how you can do the same. So get ready for some deep insights and actionable takeaways that you can implement in your life and business starting today. And today, I'm super excited to introduce a guest who has mastered the art of turning overlooked opportunities into major wins. Benjamin Spiegel is a seasoned special situations investor with a knack for identifying hidden value in commercial real estate, corporate credit, and private equity. Over the past decade, he successfully managed and deployed over $500 million in capital, proving time and again that the right strategy can transform undervalued assets into powerhouse investments. And we're going to get into that story because it's awesome. As the founding general partner of Redwood Capital, Benjamin leads investment strategy and business development, making waves in the industry by restructuring businesses, acquiring distressed assets, and delivering impressive returns. And his track record speaks for itself, whether it's revitalizing companies emerging from bankruptcy or driving high-value exits. He knows how to create real measurable growth. Before launching Redwood Capital, Benjamin honed his skills at top firms like DG Capital, Cedarview Capital, and Barclays, where he consistently delivered results and outpaced the market. And he also serves on advisory boards for REITs and startups, helping guide the next generation of high growth ventures. So get ready for an insightful conversation on smart investment, smart investing, strategic decision-making, and how to spot opportunities others miss. Benjamin, thanks for being here today. I've been waiting for this one because you have such a fantastic journey of where you started and where you've gotten to. So let's get into that. Let's go back to the early days of your career. But let's walk the audience through when you got out of college and was starting, where you ended up and what you were doing.
Yeah, so I landed a job at Barclays Capital, which is an investment bank. I served a unique role in that I was structuring very bespoke credit instruments to ultra high net worth individuals that owned major companies or sports franchises. So I really acted as an intermediary between the wealth management platform and the investment bank, really that's where I honed my skills in terms of just simple underwriting of analyzing companies. And that's really where I was able to start seeing what successful companies had in common, what the real themes were that created profitability and, more importantly, sustained profitability. So I did that at Barclays for almost 2 years. At that point, I was fortunate enough to get a job on what's called the buy side, working for hedge funds. I moved to a firm called Cedarview Capital, where they invested primarily in only private companies, but their debt instruments, leverage loans or high yield bonds, whether it was a private equity firm buying a new company, which is called an LBO, or they were doing an add-on acquisition, or something called a dividend recap, which is where they would refinance their existing debt with a larger facility and pay themselves the distribution. So I was there for another couple of years and really honed my skills even more and that's really where I started to realize the value of relationships, how important relationships are in almost any business, but especially when you're dealing with illiquid assets and that don't trade electronically, they trade by appointment, and starting to realize how important getting that first call was in terms of being able to generate opportunities. And then my career went on further. I grew even more from what you could call more vanilla investing to more special situations, which is another word for bankruptcies and restructurings, stressed and distressed situations, loan to own, where we would buy.
So the technical term for that was special situations?
Yes.
I love that. But what a good way when you're like, so if I'm an investor and you're going like, hey, we're going to go buy this company that's in bankruptcy, I might go, I don't know. But you're like, hey, we got this amazing special situation. Suddenly it sounds so positive. I'm like, yeah, I went in on the special deal. I like the phrase vanilla investing. You should write that. That's your first book right there, The Secrets of Vanilla Investing. So you mentioned in your first couple of years working with Barclays, that's when you really started to see what it was that made businesses profitable, and more importantly, what kept them profitable. So can you share 2 or 3 things that as an analyst that you could look at a business right away and know whether or not that they were going to continue being profitable, or, and at the same time, like, were the things you could look at a company that seemed like it was doing really good, but then it would go, oh man, in 2 years, this company's going to be in trouble because of XYZ.
I'd say it really comes down to two things. One being some type of recurring revenue source. Doesn't have to be a software as a service contractual revenue, but it has to have some type of reason to exist. Is there a reason to exist? And then also, I would say, kind of moat around it is the business. What kind of like what competitive differentiators that this business have that make it special? Why and why would somebody choose this business or this business products or services over someone else? And a lot of times it's not always what you think. It could be just a company spending an excessive amount on advertising to just get the eyeballs, to get people to their business or their goods or service, rather than the actual quality being better. So it's really every business that I saw had some type of niche. And the businesses that I was coming across were already at a point that had generated some level of stability, but we're still, thing is, so I have no experience really investing in public companies. Any company I've ever advertised was always private. I enjoy that a lot better because with a public company, everyone and their mother can look at their financials and see what's going on. And that's why I truly believe that really the only investment opportunity, of course, it's important to have some allocation to public equities or index funds, but I truly believe that the only real outsized returns on a long-term basis are made in private investing.
What's interesting is probably 8 or 9 interviews ago, I was speaking to somebody who was running his own hedge fund, and his prediction was that over the next 10 years, he said that the rise of really huge private companies was going to explode. And he said you were going to see fewer and fewer IPOs and fewer, even some of the bigger public companies were eventually going to go private. And he said that was kind of the wave of the future where business was going. So it's interesting that you're also saying that. So when you got into distress and you started working in special situations, were there things that surprised you about, I guess, that particular niche of investing?
Yeah, I mean, basically, when you get to this level, that type of investing where to even be a participant, you have to be what's considered a QIB, or a qualified institutional buyer, which basically means at any given time you're managing no less than 100 million in liquid assets. You think that most people are going to be pretty smart, and to get a competitive advantage is going to be very difficult. But for example, a lot of situation I like to bring up is the bowling alley, the largest bowling alley chain in the United States, AMF Bowling, or now it's called Bowmore AMF. Or they have a few different named Bolero. I'm sure most people watching this podcast have seen them from one place to another. I think there's about 650 of them throughout the country. So this opportunity came across my desk. There was at the time it was just AMF Bowling. It hadn't merged with Bowmore, but it was in bankruptcy for the second time in the last 10 years, and no one really wanted to touch this thing with a 10-foot pole.
How many locations did they have at that point?
I think 350. And basically, there was a plan that was starting to get put together or ideas were murmuring about Bowmore and AMF, this boutique, much smaller bowling alley called Bowmore. At the time, they had 8 or 9 centers. One was in the East Village in Manhattan, one was in Times Square, and they had about 6 or 7 others across the East Coast that had a much more niche strategy, which was like really high end, customer focused, and also adding in lots of ancillary offerings, whether it was hangout space, really nice bars, TVs, making it a gathering that had bowling, but that not being the sole and dead all people
It was a
purpose
social
of the
space that just happened to have bowling
Yes.
attached to it.
Exactly. So what ended up happening was this company, as I was able to work with the plan of reorganization to have Bowlmore and AMF merge while AMF was in bankruptcy, and have Bowlmore, the CEO of that company, take over the combined company upon emergence from bankruptcy. And it's very difficult to put a plan of reorganization together and to get it passed by the creditor committees and take it through bankruptcy. But on the other end, even once it emerged from bankruptcy and we were trying to secure the exit financing, just because bowling had a stigma, like there's no money
I
to
was
be
going to
made.
say, as an investor, I don't think of a high-end investment of being a nationwide bowling chain.
Exactly. It's a good example because a lot of times the best investment opportunities are disguised, or they're diamonds in the rough.
Mm.
They don't necessarily look good at first glance. If they did, like a company like, let's say, Nvidia, like the AI leader, obviously people have done very well in that, but that's considered a sexy investment. These opportunities that I've made my money in over the years are the utter opposite, are the most unsexy investments you can imagine. They do not look attractive from the surface. People are not drawn to them. If anything, they overlook them, or they're misunderstood, or there's a stigma. And there were so many little levers to pull to really bring this company to glory. For example, every bowling alley, every AMF was opening at 8 or 9 a.m. in the morning, catering to like the old lady leagues. Like they would want to come in at 9 a.m. and bowl, but then they would sit vacant for 4 hours until the next, till anyone would even show up, and then they wouldn't really get busy till 4. And really, nobody, when this company emerged from bankruptcy, it was doing about 65 million in EBITDA, which is earnings before interest, taxes, depreciation, or amortization, which is just a proxy for profitability, revenue minus expenses. But nobody realized that if they stopped opening at 8 a.m. every day and they opened at 12 or 1 p.m., that was it. That would double their earnings just
That's
simply
crazy. Just
by
by opening 5 hours later, you now doubled profit or earnings. Wow.
exactly.
So
And
when you were looking at to do it as a deal, is that one of the things you uncovered? Is you were like, why are these guys opening at 8 a.m.? If we just opened at 1, we would, and is that what made that then for you go, this is actually a really good investment because people aren't seeing like what their actual problem is here?
And then there was also there were a myriad of other problems. There was leakage. No, the bartenders were stealing, or they're pouring their buddies,
Overpouring.
well over pouring. Nothing's measured, nothing, and just a ton of bloated expenses, tons of inefficiencies, too many people on the payroll, and really not negotiating favorable tax treatment with the municipalities that the locations were in, and there was just so much room for incremental expansion that's just on the margin side. And but then on top of that, we started realizing if we could implement a strategic capital expenditure plan and really identify the top maybe 15 to 20 locations in the highest median income MSAs that had the most potential for growth. If we put 2, 3, 4, 5 into these centers, what could we do with them? What would our return on an investment be? And it became abundantly clear that the returns on invested capital for those capital expenditure programs were just enormous. And long story short, the company, when it emerged from bankruptcy, bought the debt, and then we were also buying the equity, what's called the post-reorg private equity in the secondary market. You can't go online and find this stuff. It's traded over Bloomberg terminals, and it trades by appointment on the phone. But we were able to get in at about a price of $5 a share, and roughly 4 years later, we were bought out by a private equity firm called Antaros Group for the equivalent of about $82 a share.
That's just a slight bit of an increase. Was at that point, was that in your career, was that one of your biggest deals?
It is. It was one of those deals that don't come around that often.
So did anyone at any time come to you and being like, Ben, that was a genius? No one else saw this deal, but you did, or where they were just like, here's your commission check and good job.
Well, I mean, so did not do this alone. There was Credit Suisse was highly involved. They provided the majority of the exit financing. There was another private equity firm, huge, called Cerberus. They played a huge role as well. Also on the helping bring in Tom Shannon, who was the CEO, and working out all of the compensation agreements. Because another thing is incentivization is everything, and having skin in the game is also very important. A lot of people, and especially in real estate, they with their property managers, they look at them, they want to pay them as little as possible and want them to do the
Little as possible, and they want 5-star treatment.
Exactly. And that's just not how the world works. That's why even private companies that are owned by private equity firms are owned by more sophisticated individuals. You'll see that they have stock options. Even though it's a private company, you're able to implement stock option plans. Even more so, I'm a firm believer of what's called ESOP, employee stock option plans, because I just believe that any amount of potential profit or even ownership of the company, of course, it's non-control that you're giving up. If your employees wake up every day and they actually, and they know that they have, even if it's the most minute sliver, if they feel that they have a piece of ownership of a company, their whole attitude about their job and their work ethic is going to be dramatically different.
Yeah. Yeah. So that's interesting. So I live in Las Vegas, and we've seen as a lot of the resorts and the casinos have become part of big conglomerates. We've seen them trying to like essentially nickel and dime people. One of the things they did, which was really interesting, is that in 2020 they used that as an excuse to get rid of all of their concierges. And if you've ever seen movies from like, the 80s and the 90s, like some of these resorts, there's that high end concierge that can make magic happen. And that is they're guys that have spent their entire career here, and they got rid of all of them. You can't find a concierge really now. And what's interesting is if you look at 2020 and you look at the reviews of these resorts, like the reviews have been just slowly going down, and the reviews are getting worse and worse and worse, even for like really big places like Bellagio and Caesar Palace. And their marketing team are going, well, it's because we got a younger crowd and they don't understand and whatever. And like the big thing is like it's just hard to find help anymore. And so it's interesting, like you were saying, right, that here they are now, they're like, they want to pay the least amount of money and charge the highest bit of price, and then they kind of are like complaining of like, why are people leaving us such bad reviews?
That is not exclusive to or just the the hotel and casino, the gaming industry in Las Vegas. I mean that's everywhere. I mean even in like the RV park space. Yeah, but you see it. You see companies coming in, doubling rent and not making any upgrades to the service or the product. The reviews are getting so bad for some of these parks that they're having to change their name for the third time in 3 years.
Wow, that's their solution. We'll just rename ourselves something else, and hopefully no one will figure it out.
Well, they're trying to get away from the bad reviews, new website, but it's not always that simple, as you know.
Jeez, wow. All right. So what point then? With the exit of the bowling alleys, was that sort of the launching point for you to say, you know what, I'm going to now go off and form my own company and start doing this on my own? Or what was that process like?
So, that was early on. I think I was 24 at the time when I was able to
That was a good deal to pull off in your early 20s.
Yeah, I stayed around for another couple of years, and about that time, around those years, I always wanted to. I knew about buddies that were investing in real estate, and so I made a rule that I would take half my bonus money every year and buy a small building in the outskirts of Manhattan or New York City, in the Bronx or right outside of the Bronx, more workforce housing. So I did that. I bought 1 or 2 buildings a year for the next 5 or 6 years, and when I was given an opportunity to buy a much larger portfolio through what's called a non-performing loan sale. And that's really when I had my breaking point, and I had to make a decision. Do I continue doing what I'm doing now in my cushy Park Avenue hedge fund job, or where essentially I am still working for the man. I'm a W-2. I'm a trader and an analyst. I'm getting compensated well, but on that Bowlmore deal, I made out well, but my boss that I was on my knees begging to do it made 100x what I did. So, that's really when I made the decision that it was time to make a leap of faith and trust myself and go off and buy that portfolio and do this full time.
What was that first year like, leaving the cushy job to being the guy in charge of
It was,
everything?
I mean, it was a big ego check, a big check on the ego. I went from, like I said, working at a hedge fund, a cushy hedge fund, to knocking on doors in not so nice areas of town, I'll say. Even though I had a property manager, I was still heavily involved. You know, I really had to roll up my sleeves, and more importantly, though, the best lesson that it taught me was just was the ego check and just coming back down to earth. Even though I knew I was doing the right thing, sometimes in these big cities, especially when you're in a small group of people, it's easy to kind of get complacent and just to kind of go off and forget who you are. So I want to emphasize that that was one of the best kind of lessons that buying this portfolio and then restructuring it and then selling it. And the only reason why I bought it was because I owned other buildings there. I knew the in-place rents were, let's say, $1,000 a month. And I knew that through the Section 8 government program, they would pay me $1,600 a month for the same exact apartment. So it wasn't rocket science. I like to keep things very simple. Really, the only variable was how long will it take me to get the existing tenants out, renovate the apartments to Section 8 standards, and then get the new tenants in. We were able to exit that portfolio almost about 2 years after I bought it, for a significant profit. And that's when I formally started Redwood Capital.
Wow. And so what's the goal for Redwood now? Now that you're here, you're down the road, like what are you focused? Well, and I know part of it's the RVs, but where did you start? And as you've built your company, how has your sort of philosophy evolved?
Usually when you're working at a hedge fund, you have a strict sector focus. You're metals and mining, you're in gaming. I was always a generalist, and that I am much more of what's called a bottoms up analyst, in that I'm cash flow based. I always factor in the big macro, what's going on, the big macro, the interest rate environment, currency rates, national debt. But I am an analyst that really tries to find investments that will perform regardless of broader economic conditions. I'm not holding my breath when the Fed is reporting what rates are doing, or unemployment comes out. My investments need to be in a place where I'm able to buy them at such a discount, and I have a very simple restructuring plan that I know it's going to work regardless of what happens on these broader economic conditions. And so,
So
like
when
I
you were
say
in the
that.
hedge fund, did people look at you and think you were a little weird because you were a generalist?
No, because I'd say even though most hedge funds analysts are sector specific, it has become a little bit more normal to be a generalist. And that's really what I bring to Redwood, in that even though our core focus is real estate, we will selectively invest really in any type of situation where we feel we have an exorbitant competitive advantage over the other market participants, whether that's inside information. Because don't forget, in the private markets, there's no such thing as inside information like there are in the public
Another
markets.
bonus.
So I will not invest. If something's like, for example, if the listeners like, if something's listed online anywhere on LoopNet, Frexy, like, my firm opinion is it's not worth buying. It's just
Wow.
that's truly how I believe, in that, at least for me, because I need to be able to offer my investors at least a 20 to 25% annualized return with very little risk. And you cannot do that buying things that everyone else in the world is able to see. You
Mm.
have to have some type of competitive advantage on the sourcing side to be able to buy it all, like, off market.
I love that. There's the title for your second book. Never invest without insider information. That's going to be a bestseller because people be like, "What?" You're like, "This is why the private market's the best."
And it's really crazy, because I was on the phone with a prospective investor out of Kansas yesterday, and there is so much capital just sitting around, because a lot of individuals and business owners, they believe that, or they're under the false assumption that they need millions upon millions of dollars to invest in these things, and they don't. To be what's called an accredited investor, which is the guideline for what you need to be to invest in one of these types of deals or my deals. You need to show a W-2. You need to show income of only over 200,000 a year for the past
Wow.
3 years.
That's an
And if you're
accredited investor.
Yes, and that's why a lot of people, including myself, believe there's trillions of dollars just on the sideline that people have in cash or they just have in index funds or bond funds, and because they don't even think that they would be able or had to have or even really know where to look to start investing in these higher yielding, more more attractive risk adjusted return situations. But the reality is that's why BlackRock, Blackstone, all these big companies, they're putting together programs now to start making a big push to educate individuals that there are these opportunities and you don't have to be worth millions of dollars to benefit from from these unique opportunities.
Wow, that's fantastic. All right, so before we had the call, you were talking about one of the things that's the most exciting part of your business right now, which was RV parks. But it wasn't just RV parks; it was luxury RV parks. So how and when did that come onto your radar? And let's talk a little bit about the RV industry, because I think most people, and myself included, when we had the conversation, right, there's very much sort of like a cliche view of what you think of as an RV park,
Stigma.
and how that is changing now. So that's the first off. Let's start, like, when did RV parks as an investment first pop up on your radar?
Yeah, so back in 2021, I started investing in mobile home parks, which are different from RV parks.
Sure.
They're not mobile homes. I mean, they can be moved, but they're never really actually
Sure.
moved. They're the
Yeah.
physical structure. They're not on wheels. RV parks is where they're on wheels.
Yeah.
People can drive them in and out. I started to invest. New York passed New York State, passed some pretty arduous laws around the time that I sold this portfolio. And it really kind of scared me into realizing I needed to diversify both from a geographic perspective into more business friendly or red states.
Were the laws around specifically real estate?
So, I mean, I'll put it was New York State came out and said that any apartment building that was 6 or more apartments that was built before 1979 is now officially considered rent stabilized. And now we, the state, are in control of how much you can increase the rent.
Ouch. Yeah. When I lived in LA, there was one. It was really interesting because, most people think of LA as like it's one city, but it's actually a conglomeration of like 12, right? And I think two of the cities had rent control, and one of those cities happened to be right on the beach. And I remember in the building, because I actually managed an apartment building for about 5 years, and we Ocean View, and I just remember the guy because he was such a personality. He was essentially the equivalent of Hulk Hogan, but in Italy. So he was an Italian wrestler from the 70s, hugely famous back then. And the reason I'm bringing it up is because he had a 2-bedroom apartment that he had moved in 1974, and he never moved. He was paying, his rent was, I think, $500 a month.
Well, why would he move?
And right. And then, like, my apartment, which was a 1-bedroom, was $2,400 a month. And when I moved, they put it back on the market at $3,500 a month. And so this guy, everybody's paying 4, 5, 6,000 a month for their apartments, and he was $500 a month because it was rent stabilized, right? I think they were like, his thing was like he could go up 3% a year, and over 40 years he went from whatever it was to 500 a month. When you're owning the building and you're going, the apartment right next door, I'm getting 3,500 a month, and I can't raise this guy's rent, or I can't get him out. Like, yeah, that's painful.
It's even more painful for the people that were just buying buildings. I mean, basically, it's caused the major New York lending banks to go bankrupt or to have to sell.
Wow.
And the most recent kind of sale of loans backed by these rent stabilized properties was to Cantor Fitzgerald at somewhere at like 60 cents on the dollar.
So I just want to show how big of a deal this was, like, for you. Like, you were looking at the building and you're going, okay, I can get everybody out, and I know the market rate of rents is this amount. So over a year I can get to this point. So you're basing all of your projections and cash flow off of that, and you buy the building, and New York changes the law, and now all of your numbers are out the window because you can't do what you thought you were going to do.
And then on top of it, it's a borderline unconstitutional, in my opinion. I believe it's the taking of private property. Do you really own a deed if you can't control what you want to charge for something, or what the service is? But so that scared me into moving it to the Sun Belt. That's where more growth was in general. Even though I'm not a macro guy, I believed that finding discounted investment opportunities in areas that were experiencing more robust growth was a good plan.
It's like
I started
Mobile,
in
Nashville.
Yeah, more the Gulf Coast.
Yeah.
Also, but given my kind of contrarian thinking, I wanted to go to what's called secondary and tertiary markets. So not necessarily areas that were already popular, but maybe areas like that were on their way or in the early stages of becoming primary markets, as they're called. And so I bought some mobile home parks around North South Carolina, and that's really when I first got, because there's an overlap in the brokerage community between mobile home and RV. That's when I first got interested in the RV park space. And since then, I've really spent the past almost 3 years doing a exhaustive, borderline obsessive deep dive into every minute aspect of this industry. And I really have never found one that has excited me as much as this one.
Wow.
I mean, just to kind of like what we were talking about the other day, I mean, so you got, just to rattle off some figures, you got about 13 million owning RV households in the United States. About 1.5 million of those live in their RVs full time. Every
Wow.
year, about
10% lives full time. That's amazing.
and then every year, about 400,000 or 500,000 new ones are sold. And post-COVID, the average age of a buyer has dropped to the mid-30s.
And that was also the thing to me, is just shocking, because my assumption still is that, oh, most people are 65 and they're retired and they sell their house and then they use that to travel. But 35, I'm assuming a lot of that has to do with the digital remote work and digital nomads, and a lot of people being able now to, as long as you got a Starlink, right, you can work anywhere.
And on top of that, I feel like I'm confident there's been a structural shift in American core society, in that for the baby boomers, it was really all about just getting married and buying that single family home. And then you reach that level of attainment that society accepted, or you're an adult now. And I really believe, especially post-COVID, that has been just completely shattered, in that millennials could care less about either getting married or buying a home. I mean, it's also, just given the affordability, the houses are expensive, interest rates are expensive. Most millennials are choosing to, as I say, put their equity on wheels and buy an RV and be able to be mobile and go wherever they want, whenever they want, and really operate under more of you only live once mentality. And why be tied down to a certain town or a certain house?
Yeah. Are you familiar with Grant Cardone?
Yes.
He said something one time I thought was really interesting, because he was getting some grief online because, he likes to flex his big portfolio and everything. And somebody was like, dude, you don't even own your own house. Like, you're renting. And he said, the quote that made stuck with me is, he said, own what you rent and rent where you live. And he's like, because when you rent with your live, you're never tied to anything. So if something happens and you need to walk away, like, you can just walk away. Or like his point, he's like, he was in LA for a while and he's like, I want to be in Miami. And he just moved. And he's like, I wasn't tied to my own house because I was renting. And I thought that was an interesting statement for somebody at his level.
I mean, listen, I'm a firm believer. I'd rather pay 20 grand a month in rent than own my home and pay 10 grand in a mortgage. Because think about it. I mean, if you buy a house, let's say, just to be simple, you buy a $2 million house, you put 500 grand down, you take $1.5 million mortgage out. That $500,000 is pretty much, unless you're in a very specific areas, I would consider dead money. It's just it's dead, and it's also, people think it's safe. It's at risk if there's any kind of downturn in the market, as opposed to taking that renting and taking that 500 and investing in a real estate deal where you can make 2x every 4 or 5 years, and then do what's called a 1031 transaction, roll into another deal and not pay any taxes, and just do that perpetually and have that 500,000 be worth 5 million in 20 or 30 years.
Schwarzenegger talked about that's how he got started in real estate. In his biography, he said, all my friends were saving up to buy a house, and he's like, I saved up the same amount of money and I bought an apartment building that had 4 units, and I lived in one and rented 3, and that covered the mortgage. And in a year, somebody offered me double what I paid. So he sold it. And he's like, and then I bought an apartment building with 12. And then 2 years later, he sold that and bought an apartment building at 36. And then, 15 years later, he owned half of Main Street in Santa Monica.
I mean, the 1031 strategy is how the uber ultra wealthy are able to transfer money generation after generation without paying a dollar in taxes. Because let's say you take that 500,000, and by the time you're 90, let's say it's worth 25, 30 million, and you haven't paid a dime in taxes. When you pass away and your kids inherit, the tax basis resets to the market. So it's one of the most widely used wealth transference mechanisms.
I love it.
And
all right, so let's get back to
RV.
Let's get back to just not RV, but the luxury RV space. When did that come on? So you started looking at mobile homes and then RVs, and when did luxury come into that? Because that was, to me, was completely a new thing that I had never heard of before.
The luxury, it's pretty interesting because the word luxury, so luxury community, luxury RV, the bar is very low in the RV space for what's luxury. I mean, you saw the rendering, the 3D VR, that maybe you could post whatever after, but to give people a good, because a visual, it's very important to see a visual. But basically, I realized that there was this this large gap in the market for luxury RV, what I like to call communities, because the RV parks that I'm investing in are not. They're not on the beach usually, or they're not next to Disney World. They're in areas right up. They're close to a major city, but it's usually they're not in they're not on the beach. Not uber expensive land. What I am doing is creating what I would like, a good way to kind of put it in and out is like luxury townhome communities with all the amenities of what a new luxury townhome community would have, but without the actual town.
A gym, a pool, a hot tub, a playground. Pickleball court,
the dog walk, the works, and controlled entry, safety. I mean, it's crazy. 75% of RV parks, you can't even make a reservation online. You got to physically pick up the phone and try to call them. It's the most inefficient.
It's an antiquated industry still.
Absolutely. And the reason that is 85% of RV parks are owned by single operator mom and pop owners. And a lot of times they don't have the wherewithal or the resources to invest back into their facilities to bring them to the level that it's not even what's considered an amenity, in my opinion. Now it's a necessity, such as Wi-Fi and cell service. Those are necessities, and it's not happening.
So why are you now kind of doubling down on the expansion of the luxury RV space? Where do you think that's going over the next 5 to 10 years?
Yeah, so I told you about the supply side, but on the demand side, you only have about 800,000 or 900,000 privately owned RV pads throughout the entire United States.
12 million, for 13 million RVs, and there's only 900,000 spots.
And remember, 1.5 million live in their RVs full time. So there's not even enough RV pads for people that live in their RVs full time.
Wow.
Yeah. And like I said, the average age of these RV parks, there's about 16,500 of them throughout the United States. And the average operating tenure is about 40 years. So they're old. And like I said before, 85% are mom and pop operated. And there's so many inefficiencies that if you're able to source and be able to create mechanisms for continual sourcing to be able to build up what's called a deal pipeline of these smaller, what I like to say, lower middle market RV parks, and enhance them through amenities and better service, and ultimately consolidate all of them together. What I mean by consolidate, bring them under one umbrella organization and benefit from economies of scale, and then also AI, like putting a chat bot on your website to be able to walk a prospective renter through everything about asking questions about the rent, the fees, the location, how do I move, and all the way through making the reservation. Just think about the margin, and that's one less camp worker you need. And I've seen $100 million plus asset owners in the RV space whose logos look like their 2-year-old son drew them. I tell it's there's so much inefficiency. And also why I love it is because it's very difficult to deploy a large amount of capital at one time. The sweet spot, as I like to say, in the law is between like the $3 to $10 million range. All these institutions come in and they're like, well, okay, well, the minimum deal size I can do is 20 million. That doesn't really exist. And if you're buying a $20 million asset, it's already there's not much value left to add. It's like a very wealthy family office buying it, for current yield, and then, just holding it forever. But that's not what I do. And so that keeps institutional capital at bay. So when you have a confluence of the 85% mom and pop own institutional capital not coming in, and then this gaping supply demand imbalance that's growing and growing and compounding annually, it just creates the perfect storm if you're able to identify, even on top of that, specific geographies that are experiencing tremendous growth, but nobody's really talking about.
I love it. That is awesome. Yeah, I'm like so excited about the luxury RV space moving forward. Like it's so exciting to me. Look, you've been super generous with your time today. Before we leave, I got a few questions I like to ask everybody. So I'll have three final questions, and then we'll call it a day. If you could go back in time and give your younger self one piece of advice, what would it be and why?
It would be a little bit more patient, be frugal, and be humble. Sometimes when you have success at a young age, it gets to your head and you think that you really can't do any wrong. But it's real. This business, it's not necessarily about your performance. It's about staying power. It's about longevity, and it would really just be more frugal. Always consider the time value of money. You're gonna buy 10,000. You're gonna spend 10,000 on a Rolex now. What could that $10,000 be worth 10 years from now? So that's the way I like to think now. That's what
I was laughing because I worked in Hollywood for 15 years, and if there's one place where people get insane egos, it's when they're 19 or 20 and they have a movie or a TV show pop, and suddenly, they're making a few $1,000,000 a year to do it. And everybody starts taking themselves most of the time overly too seriously. And they actually believe the hype. And most of them, that's why most of them flame out in spectacular fashion too, right? Because they don't have any humility. All right. So
they're not saving. They're not investing. They're
and that's the other part. Yeah. They're burning through it. So what belief or mindset shift has had the biggest impact on your success and your happiness?
It's really a couple of years. I started to really try to make things very simple. I have so many people pulling me in so many different directions. I started living by the mindset, what is the best thing I could do for my family right now? And I don't have any kids, my wife. So how can I be the best husband to my wife? And I incorporate that into every decision I make in terms of when I think about doing a deal. Would my wife be happy I'm doing this, or would she not be happy? I mean, obviously there's a little bit, her risk profile, within reason. Really, before that, I started looking at everything in not a black and white, but in more of those terms of would this make my wife proud or not? And that mentality, I implemented that probably about 2.5 years ago, and that's how I live my life these days. Has really made made me much happier, has made things simpler, has made us a better, happy wife, happy life. It basically, we have a phenomenal relate, and just if things aren't good at home, it's very difficult to keep them good anywhere else. So I wanted to you really have to have your house in order. So really just kind of having, like, using that as like a sniff test to, in my life, into, how I run my business, and how I talk to other people, and how I spend my time. I think that's been pretty impactful.
Yeah, that's pretty fantastic. Last question is, what's the best investment you've ever made in yourself?
In myself. So not necessarily monetarily.
Nope. I'm bringing the good questions today.
So I'd say the best investment I've ever made in myself is forcing me, no matter what, forcing myself to work out at least 3 or 4 days a week. 3 minimum, shoot for 4 to 5. Because if I'm not working out and exercising my body, everything else falls apart. I'm not sleeping, I'm not eating properly. I need to get to the gym 3 to 4 days a week and have a routine.
It's remarkable to me how many people I've come across, myself included, that's like, man, I'm having a really hard time sleeping. And then, like, do you exercise? I'm too busy to exercise. And then even if it's just an hour of walking a day, like, just how that's simple
20
thing.
minutes, 20 minutes.
Yeah. Like what that does shift on everything. So Ben, thank you so much for your time being here. I really appreciate it. For those of you watching the show, this interview is going to become part of a book project that I'm working on called From Vision to Victory. If you ever thought about writing your own book, or you've got a lot of experience or expertise in your field and you would like to turn that into a book of your own, just hit the description below. I'll have a conversation with you. It's what I call a path to publishing call. We'll help you figure out what your best steps are to get there. Thanks everybody for being here. And Ben, thank you so much.
Hey, Travis, thanks so much for having me. I really appreciate it.